Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors, and we have a very exciting day today. We have lots and lots of news to cover. I'm sure that you're all watching a lot of this news on CNBC, on your local news station, on WHHI, and I'd like to go over a little bit of that information, but then I'd also like to cover our 6 most frequently received questions that we've been getting over the last 72 hours or so, because certainly our phones at our office, which is a wealth management office, have been ringing off the hook, not surprisingly, as sort of that panic starts to set in. There's a lot of questions, so we're going to go over those top 6 questions that we've been receiving at our office, and certainly if you have questions in the future, would love for you to shoot them our way so that we can address them here on air. But before we get to that, I'd like to go over some of the news of the moment. As I'm sitting here right now, which we are taping on Tuesday afternoon, Ben Bernanke, the Fed chairman, is about to speak. And this is a scheduled meeting, a previously scheduled meeting. It has nothing to do with what's gone on in the market over the last few days, which, as I'm sure most of you are aware, were massive declines in both the Dow and the S&P. Yesterday, Monday, there was about a 630-point decline in the Dow that was largely driven by the downgrade of the U.S. debt by S&P, which is a ratings agency. That downgrade was sparked in large part by the debt to GDP ratio, as well as what's gone on in Washington over the last few weeks. I think that the deadlock that we saw in Washington that lasted for several weeks, I think, was somewhat disheartening to the ratings agencies as they see that our government can't move fast to cover the debt situation that's at hand, and I think that that created some concern for them. So the downgrade that occurred was really largely driven by that political commentary, more so than our ability to repay our debt. So that's one big piece of news, obviously, that's driving the markets today and over the last 72 hours. The other piece of news is something that we've addressed over the last several weeks, and that, of course, is what's going on with the European Union. They're facing all of the same problems that we're facing here: the inability to pay back debt, the inability to raise capital to pay back that debt, the fear of rising interest rates, the fear of debt downgrades, which did occur in some of the countries over there. And the biggest problem that they're having is, unlike us here in the United States, where we have a single currency, a single economy, their ECB, the European Central Bank, cannot just print money the way that our Fed can, and our Treasury. So the concern that they have over there is, how are they going to address each of those individual failing economies? What's going to happen to the euro, and what's going to happen to the EU? Is it going to continue? So, a lot of concern, lack of visibility over there, also driving the markets downwards. So those 2 factors are really what has had the largest impact on our markets over the last 72 hours, or at least last Thursday, Friday, and again yesterday. So as I said, Ben Bernanke is going to be addressing the country here right now, and he has a couple of options available to him as to how to reduce market concern. One of those, of course, would be a quantitative easing 3, as we've talked about before, which would just be pumping more money into the economy. I don't think that that's likely to happen. Most of the pundits don't believe that that's going to happen. It's been somewhat unsuccessful in the past as far as improving market conditions. It has a short-term impact, but it has not shown to have a long-term impact, long-term positive impact anyway. So it's unlikely that will happen. It is likely he'll have some commentary saying that we will have prolonged low interest rates, really, really, really long, something along those lines, as opposed to their typical black box speak of, we just don't know how long it's going to be low, but for some period of time it'll be low. So we'll likely hear some commentary like that. The other thing he could do is he could buy back bonds at the long end of the yield curve, say the 20-year or 30-year bonds, which would serve to increase the yield curve, which is something that probably needs to happen. And we'll actually talk a little bit more about that today in this show. So that's sort of a wrap-up of market news as we sit here right now on Tuesday afternoon, and I'm certainly sure that there's going to be a lot more exciting stuff coming throughout the remainder of the week and several weeks, so lots to discuss. And so let's take a quick break. We'll be back in just a minute, and I'm going to address the 6 most frequently asked questions that we're getting from our clients right now, and hopefully there'll be answers to questions that you have as well. This is Money Matters, and we'll be back in just a minute. Welcome back to Money Matters. I'm Emily Johnson, and for the remainder of our show, I'd like to discuss the 6 most frequently asked questions that we've been getting at our office over the last 72 hours or so with regards to what's going on with the market, try to maybe reduce any of the fear that people are feeling, have some of the panic subside. I'm hoping that that's what's going on in the markets right now, and also just address some of the verbiage that's floating around on some of the news stations that can be a little bit confusing. So one of the first questions that I get a lot is, why did the S&P downgrade U.S. debt? Is it because we can't pay back the debt bill that we have? We can't pay the interest? What is the reason that the S&P, which is a ratings agency, downgraded the U.S. debt? And it's a very interesting question because we are actually able, we being the U.S. government, are able to repay the interest on our debt. We are at the moment able to do that. The reason we're able to do that is because our Fed is able to print money, basically. So in the event that we couldn't repay the interest on our debt, our Fed would actually just go and print more money to enable us to pay that debt. The negative of doing that, of course, is that it will devalue the dollar, which in the long run tends to be somewhat of a negative economically. But we're not going to get into that as much right now. The reasons that the S&P, the ratings agency, cited in the downgrade of our debt were really twofold. Number one, it was our debt to GDP ratio. It is historically at its highest level, and their concern is that it's getting out of control. Our GDP, which is basically our government's or our country's revenue, is going down. So if you consider that the ratio is debt on top of GDP, our denominator, our revenue, is going down. Our debt, on the other hand, is going up. And of course, we just saw in the news the raise of the debt ceiling that's occurred by yet another $900 billion or so, and expected to increase to over $1 trillion in the near future. So that means that our debt is going up. So that means that overall that ratio, that debt to GDP ratio, is not only out of whack now, it's going to be increasingly out of whack. And that's one of the big things that the S&P ratings agency was looking at, is that that's not being addressed. Second is really a political commentary and the fact that our policies are not necessarily changing. That debt is going up without any concern about what's going on with regards to spending. The fact that we spent weeks and weeks, if not months, with our Congress and Senate debating this issue and still not coming up with a real resolution that really attacked spending, really attacked revenue, that I think was demoralizing to not only the U.S. population but also to the ratings agencies, who looked at the stalemate that occurred and realized that the U.S. just cannot move on a dime like that. We can't. And what if the day came that we could not pay back the interest on our debt? We were unable to print money the way that we'd like to. That was a huge concern. So really, it was largely a political commentary on the fact that our policies need to change. So that is basically why the S&P downgraded the U.S. debt. The next question that I get pretty frequently is, why did the downgrade of the U.S. debt impact my equity portfolio? How did those two things relate? And there's a diagram that will appear up here next to me. I think the easiest way to explain this is to explain how debt ties into equity. So first and foremost, let's take an example of a company, say Johnson & Johnson, which is one of my favorite examples because I'm Johnson. So Johnson & Johnson is one example of a company. You have multiple levels of debt and multiple levels of ownership within this company. And you can see the top level of debt that's there is your secured debt. That's going to be the same as, say, your personal mortgage debt. That's going to be your lowest risk, lowest interest rate debt that you're going to have, or that any company is going to have. Let's say, for example, 3%. Just below that is going to be unsecured debt. That's, for example, your credit card debt. Companies have the same thing. It's not secured, therefore the interest rate is going to be higher, and every company, most companies are going to have secured and unsecured debt. Below that, you're going to have what's called high yield or junk debt. And junk obviously is not the best word, but high yield debt. So the interest on that is going to be even higher. The reason that the interest is higher is because the further you go down that food chain or corporate structure as you're looking at, the less likely you're going to get repaid in the event of liquidation of that company. And then below that you have preferred stock. Once we get to stock, preferred stock and common stock, that's where you're getting to ownership in the company. So in the event that the company goes under, those first levels of debt will get repaid first. There's less risk there. And if you're one of the owners, chances are you're not going to be getting anything back. You're just going to be foregoing your investment. So in the event of a downgrade, when the interest rates have to go up as the risk level goes up, the interest rates are also going to go up. So the cost of that debt is going to increase. Therefore, the likelihood that the company can pay back that debt is going to go down. And as a result, you as the stockholder are probably not going to get paid back in the event of liquidation. So therefore, your cost or your price in that company is going to go down. So that is why you're probably watching in your 401k, you're probably watching your mutual funds, your large cap mutual funds, your small cap mutual funds take a nosedive, because those are comprised of individual stocks, also called equities, and as interest rates go up, chances are, well, at least in this case with the downgrade, the value is going to go down. The other reason, of course, they went down is just by sheer panic. The market as a whole was down about 7% or so yesterday, so sheer panic was driving a lot of that relationship as well. So the next question that I usually get is what relates to the bonds and bond funds, and we're actually going to get back to that here after our commercial break. So if you can bear with us for just a minute, we'll come back and we'll address question number 3, which is how does this downgrade affect my bonds and my bond funds? We'll be back in just a minute. This is Money Matters. Welcome back to Money Matters. Okay, we just finished talking about how the U.S. debt downgrade impacted our stock portfolio, impacted our 401ks, our mutual funds, tried to explain a little bit about how those two things relate. The next question that we usually get, sometimes at the same time, is how did this U.S. debt downgrade impact my bond portfolio? I have treasury bonds, I have muni bonds, I have bond funds. How did it impact my bond portfolio? And it's a more complicated question because it really depends on what kind of bonds you have. So we want to address that first. First, talking about the relationship between interest rates and bond prices. So there's going to be another diagram that appears here, and we always think about this relationship, this inverse relationship between bond prices and interest rates as a teeter-totter. Basically, as interest rates go up, the price of a bond is going to go down, and vice versa. As interest rates go down, the price of your bond is going to go up. So over the last few months, as you've seen interest rates continue to go down, the price of your bonds have probably gone up. On the flip side of that, whenever you see a debt downgrade, that means that the issuer of the debt is going to have to pay a higher interest rate, which typically is going to increase interest rates, which is going to drive bond prices down. So we have sort of those two things in flux. Yesterday, as we saw interest rates go down, we did see bonds actually increase in value. There is a concern, however, that going forward, because rates are so low, we actually had negative short-term rates for the first time in U.S. history, I believe, occur last week and again yesterday. The 10-year yield right now is historically low at 2.3%. That is very, very low. So the likelihood that rates can get any lower is very small. So thinking about this relationship again, if rates have to go up, which they most likely do at some point in the future, then bond prices are going to go down. Therefore, you're going to see the value of your individual bonds, the value of your bond funds go down. That relationship stands for corporate bonds, municipal bonds, treasuries, and also for agency bonds. There's lots of different kinds of bonds out there depending on what your portfolio holds. One other thing to think about when it comes to bonds is whether you hold an individual bond, say in the Cross Island Toll Bridge or something along those lines, or whether you own a bond fund, which is composed of lots of different bonds. If you own a bond fund, chances are when interest rates do eventually go up, your fund is going to get hit a little bit harder and faster than an individual bond might. Counterintuitive because you have lots of bonds in that fund. However, you're also going to be subject to the move of other investors. So if you have a bond fund and all the other investors decide that now is the time to exit the market, that bond manager is going to have to sell a lot of those bonds, and he might have to sell them at a fire sale price simply to settle the sale of the other investors. When that happens, you could be left holding the bag, and therefore your bond fund could actually get hit a little bit harder than individual bonds. That doesn't always happen, but that is certainly something that's a concern. So we have a lot of different things to consider there. and certainly the different types of bonds that you hold, muni bonds, corporate bonds, treasuries, all responded differently. So that's sort of a basic relationship to give you a broad overview. And certainly if you have any other questions, please contact us, and I'm happy to go over that with you in greater detail. That moves us on to our fourth question, and that is, what is the fear index? I'm sure that everybody has heard this term fear index out there, and it's certainly not anything from Nightmare on Elm Street. It might feel that way right now. It's not, it's certainly not something from Halloween or anything like that. The fear index is just referring to the volatility index, or the VIX is another way that people will say that. That's the ticker for it. And basically the volatility index goes up with volatility, and it goes down as volatility subsides. Now, volatility is kind of a misnomer, because what volatility means, and I should have another diagram for this, is just rapid movement in the market, like a heart rate, up and down, up and down. That's high volatility. That's a number that you're going to see somewhere, say, in the 30s or the 40s is what the VIX index will indicate in a very volatile market. But if you have a steadily down market or a steadily up market, the VIX is just measuring that volatility, whether it's up or down. So it's not a measure of whether or not the market's going up or down, it's just a measure of volatility. But volatility often creates fear. I don't know how your stomach felt yesterday, but mine was pretty much in knots. And that is usually a measure of volatility. That's how people respond to volatility. Typically, fear is a bigger driver than greed, and I think that's where the name of the fear index comes from. So when you hear that next time, don't be concerned that we're having a massive fallout in the market. It could actually be, if we have a huge rebound today, the VIX could actually go back up again. So it's not necessarily a negative indicator, but it is certainly an indicator of volatility and uncertainty. Fifth question, what factors created the huge swings in the market? Wasn't the downgrade already priced in? Everybody always says, well, the market already assumes such and such is going to happen, so why did we have a 1,500-point decline in 72 hours? That is unheard of. In fact, yesterday's decline, Monday's decline, was the third largest in history, the largest of which, of course, was September 11th. You wouldn't think, and that was almost 10 years ago now, you wouldn't think that this would be on such catastrophic levels as September 11th, but the market moved a huge number, about 6-7% in one day. What's causing that magnitude of decline? There's a lot of answers to that. Of course, one might be people saying it's a panic. Another one that I think is a more interesting argument you might have heard is what's called, they're blaming it on high-frequency trading. High-frequency trading is nothing more than trading that is driven by computers. So, you might hear hedge funds, you might hear, different mutual funds use a lot of computer algorithms or computer formulas to drive their trading. And basically what they do is they'll create a computer formula that will say, when the market moves this much, we're going to put this much money in, and then when it moves this much, we're going to take that money out. Now, they are not only day traders, they are moving money in and out in a millisecond. They might move millions of dollars in and millions of dollars out within 3 seconds. And when that happens, you see large volume flowing into the market, which moves the market substantially, and then large movement coming back out again. So there's a lot going on with these formula traders, high-frequency trading, and that's definitely causing a shift, a very dynamic shift in how the markets are moving, and I know that's something that the SEC is going to be addressing. And last but not least, we'll talk a little bit about my favorite question, and that is, my 401k is tanking again. It's only been a year and a half since the last time I saw this happen. I'm not sure that I can stomach it yet again. What is it that I'm going to do? What do I need to do? And the biggest piece of advice that I have, or the biggest response that I would have, is do not succumb to the fear sell. Fear is obviously and always a bigger motivator than greed is. And selling into a down market like we had yesterday is the worst thing that you can do. If you're already there, then you basically need to take the time to assess where your portfolio is. What is the overall allocation? What is my risk level? How long do I have until retirement? When am I going to need these funds? And then look at the individual holdings. Are they sound holdings? Are they holdings that you're okay maintaining? Are they fundamentally sound? Meaning, are the companies that you're investing in inside the mutual funds, are they sound? So be looking at those things. Do not succumb to the fear trade. Potentially even consider putting, depending if your stomach can handle it or not, putting a little bit more money to work incrementally as the market goes down. That actually will hopefully help you achieve a lower average cost of your holdings. But Just stay the course, really look at your portfolio fundamentally, assess your risk tolerance, and take that all into consideration. So those are the 6 questions that I have been receiving most frequently over the last week or so, last 72 hours. Hopefully that's been helpful for you. We're going to take a quick commercial break, and we'll be back in just a second with our parting shots. Welcome back to Money Matters. I'm Emily Johnson, and I'd like to close with a few parting shots from our show today. First and foremost, ignore the panic at this point, which is basically impossible, but really take a look at your personal situation, look at your individual holdings. Are you diversified? What is your overall asset allocation? How much risk can you stomach? How far are you from retirement? And really consider, what's your number that you need, like the ING commercial that you see all the time. What's your number? Consider that for yourself, and also consider whether you need to reassess that given what's gone on with the market. Certainly this is time to assess and to think about where you stand. Number 2, if you have cash on the sidelines, have enough cash on the sidelines that you can sleep at night. That's definitely the most important thing to do, and don't let anybody convince you otherwise on that. If you have excess cash, however, when a market declines like this, it does create, typically, historically, long-term opportunities for investing. So certainly have enough cash on the sidelines to sleep at night, but then with the additional funds, perhaps consider investing them. Right now, of course, we're looking at high quality, high dividend yielding, perhaps high interest, high yield bonds, but definitely high quality, high dividend yield so that you get paid to wait. So that's pretty much our show for today. I appreciate your time today. I would like to invite you, if you would like, to join us on Friday morning at 8:30 at our office. We're going to be addressing some of these topics. We'll have a lot more news to cover at that time, I'm sure. Our office is in Shelter Cove. The address is below. Would certainly love for you to join us to address these topics. Again, Friday at 8:30. If you're seeing this show after that point, which is August the 12th, please give our office a call and we'll add you to our future email list so that you might join us on future occasions. In addition, if you have any questions, check us out on Facebook. Send me an email at Emily@Polaris Capital Advisors. I welcome your thoughts, I welcome your questions, and I really look forward to hearing from you. So that's the end of our show this week. I'm Emily Johnson, and this has been Money Matters. Have a great week.